Hello and welcome to our web chat on base erosion and profit shifting tax, BEPS as it's commonly known, and its impact on corporate treasury and how to respond. We have Graham Robinson, tax partner at PwC, who has extensive experience from BEPS and how it applies to corporate treasury. Graham, BEPS is billed as the BEPS actions are intended to promote greater transparency and consistency with increased information exchange between multinational entities and tax authorities. For corporates, it's not that simple. Overall, what do you think the impact of BEPS is going to be? What is the likely impact of BEPS?
Unfortunately, Jack, it is quite complicated. The OECD's BEPS program, as you were saying, aims to force corporates to align the way they're taxed with international norms and to increase transparency. And what that means in detail is that there are 15 areas where the OECD are going to make corporates be taxed in a different way. Now, when you get down into those areas, there are some that really impact on corporate treasury and actually change the way that some important bits of corporate treasury are taxed. Of those 15 action points, some of them are around reporting, some of them are actually change the tax rules in all the countries that implement BEPS, and that will be all the G20 and all the EU, and possibly some others as well. So when you look at those different action points, there are some that really change the way that corporate treasury is taxed. I put 4 of them on this slide. Transfer pricing is the first one. Profits are allocated between different entities in a group, and the historic focus has been on just pricing individual transactions, whether that be loans or derivatives or goods and services, and trying to find an arm's length price for that. Now, this is changing, and there's going to be a lot more focus on using transfer pricing rules to ensure that where profits are taxed matches the location of operational substance, and that means the people who actually do things on the ground. So for many corporates, you might have people on the ground doing treasury things in one location, but because of the corporate structure, taxable profits turn up in a different location. Now, a common example of that would be some corporates have a Luxembourg or Swiss treasury centre where the profits are taxed, but actually the operational people are in UK or US or somewhere else. That's going to be a lot more difficult under BEPS. The profits will in future generally be attributed to where decision-making people and real activity is taking place.
Does that mean that the corporates are going to have to record in much more detail?
Yes, there'll be a certain amount of recording in more detail what's going on. There is a new requirement that's already in force in a lot of territories, country by country reporting, which broadly means that corporates will have to report to the tax authorities on a global basis what people and what profits are in each territory. But the impact of the transfer pricing changes is not just about the reporting, it's about actually changing where the profits get taxed to align it more to the people. The effect of the reporting is that it becomes more obvious where that's not the case.
And you make the overall conclusion that it's pointing to increased cost. Is cost of capital part of it?
That's right. So one of the other actions is a very specific action, Action 4 of the OECD's recommendations, that aims to restrict the extent to which interest is a tax-deductible expense. And this isn't just talking about intercompany interest paid from, say, a high-tax territory such as UK or US to a low-tax territory such as Switzerland. This is all interest, including interest paid to external lenders. The OECD's idea is that, in principle, not all interest should be tax deductible. And the consequence of that, of course, is that when you're modelling your cost of capital, when you're looking at the cost of debt and the cost of equity, well, fundamentally, the cost of debt is going up because not all the interest results in a tax deduction. And that, I think, is going to change corporate behaviour. It will change the whole trade-off and the whole cost of capital calculation. What is the best way to source my business? It won't necessarily be the case that debt is the cheaper option. It won't, and even where it is, it won't necessarily be the case that the point at which you take on debt is the same as it was before.
There is some interaction between the impact of BEPS and the IRS 385 regs. Is that going to complicate things even more?
That's absolutely right. The IRS 385 regulation is a draft regulation, not yet in force, but expected to come into force probably around the end of the year, which limits severely the ability of a US company to take tax deductions for debt. Now, that's a specific rule on intercompany debt. It only applies to debt payable to a connected party, another group company. But that is one example of a situation where a territory has taken the principles of BEPS, i.e. interest shouldn't be as tax deductible as it used to be, and doing their own thing with it. It's a type of restriction which is comparable to BEPS, but actually it's not doing exactly what the OECD suggested. And that's one example of a trend we're seeing emerging, which is that even though the OECD set out principles for a kind of harmonisation, actually each country is doing slightly different things with it.
So things are getting worse. I mean, is the same thing happening on withholding tax?
Yes, in principle. The OECD proposed that withholding tax should be harder to get exemptions from. The situation at the moment is that when you're paying interest or royalties, or in some cases dividends, from one country to another, there will often be a withholding tax in principle, and generally that withholding tax is reduced or cancelled by the effect of a tax treaty between the two countries. What the OECD is saying is it's too easy to get access to those tax treaties, particularly when you're paying to a country where you don't have your real head office substance or your real business centre. You may just be using that country because it has a good tax rate, or even because it has a good tax treaty to reduce withholding tax. Therefore, the BEPS programme suggests new limitations on the circumstances when you can use a treaty to reduce withholding tax. The likely impact of that is that in many cases, intercompany payments which have not previously been withheld on, so interest payments from an operating company to a Treasury centre, for example, might have withholding tax on in future. Again, it's another tax cost that's being built into Treasury operations that's likely to result in an overall cost to the business.
Your overall conclusion seems to be all pointing at increased cost, but also you've got this last point about corporate structure may no longer be fit for purpose. That's rather extreme.
I hope not. What we're saying here is that all these things add up to the conclusion that the existing way in which corporates structure their operations and fund their operation might be suboptimal in future, as well as the things we've talked about, which are obviously specific taxes on specific situations and treasury flows. There are other things as well, like a rule to prevent you getting tax benefits from hybrids. Now, in tax world, hybrids means generally entities which are taxed in two different jurisdictions in different ways. And traditionally, multinational groups have got a benefit from those. There are rules to stop groups doing that in the future. Now, likely what all this points to is that groups are now going through their corporate structure and understanding where these different new rules bite and working out what to do. And in many cases, that means a significant change to the corporate, either the legal corporate structure or the business structure, in other words, the way in which different entities in the group operate and transact with each other. So overall, a big change just to kind of stand still and not have a significantly increased tax burden.
But we can't stand still because Brexit's come along.
Yes. In many ways, it's too early to say. As it, it's clear that the relationship between UK and EU is going to change, and what the long-term impact of that is. Well, we've all seen the various news reports, and it's what's clear is that it's not yet known how that will play out. But almost any change is likely to, or has a risk of, increasing the frictional taxes here. I mentioned Brexit in the context of withholding taxes because that's one area where it's most obvious. In some cases, the reason why payments going in or out of the UK do not suffer withholding is because of the EU's Interest and Royalties Directive, or the EU's Parent Subsidiary Directive. Those are bits of EU law which eliminate withholding taxes on payments between group companies in certain situations. If UK is no longer part of the EU, it seems that we will not be within the ambit of that EU law, and therefore in those situations, just as an example, there will be questions about whether new withholding taxes arise.
As consultants, you never just leave it at that. You have a response. What would you highlight here in terms of the Treasury's response to BEPS, then obviously Brexit as well? The first steps.
Sure. So in terms of responding to BEPS, the main thing is to understand, because the BEPS rules are now becoming quite clear, it's to understand what the likely impact is and what you can do about it. So looking at that transfer pricing, for example, as I was saying, the impact of those rules is that profits are located where the key people are and the key decisions are being made. So if at the moment you have a separation between the tax jurisdiction of the profits and the actual physical location of the people and the decisions that give rise to those profits, that's a fairly obvious tension point, and probably some kind of change is needed. Either you think about moving the people to where you want them to be for tax purposes, or alternatively, it may be the case that groups accept that taxable profits will arise in a territory where previously they didn't. Cost of capital is the other big cost, where you look at it and you think there are probably things you need to change. Under the OECD's recommendations, there are some fairly complex analysis as to where interest is deductible, and broadly, in each territory where your group operates, you will find that there's a kind of capacity for interest. And so what groups will need to think about is, can they access that capacity? Can they change the profile of internal and external borrowing so that interest cost arises in locations where it's deductible, taking into account the legislation of those territories and anti-avoidance, because you have to do this in a way that's compatible with what is acceptable to the local tax authority as well as what is theoretically optimum.
You seem to be raising the point that even though the OECD with BEPS was trying to make a global standard, there are going to be local variations that you have to take account of. Is that right?
That's definitely what we expect to happen, and it's always been the case before that as territories have tried to harmonise law, whether it's tax or regulatory, you see local differences coming in, or in accounting standards as well. Territories sometimes have different interpretations of IFRS that are applied locally, for example. We expect the same to happen in BEPS implementation, just because territories' local tax law, being the starting point for all this, is slightly different and has slightly different concepts. Now, some of those differences will be kind of tiny, annoying niggles that won't have material impact. Some of them are potentially bigger. Even though the US, for example, has taken on board that it's going to have restrictions on interest, that 385 regulation does it in a completely different way from the BEPS recommendation. I think we're going to continue to see that kind of difference.
Oh dear. And on withholding tax and corporate structure, are there any things you can do there?
Withholding tax is again about ensuring that when you have a cross-border payment on which withholding tax can arise, being eligible for treaty exemptions from that withholding tax, it's going to depend on being able to show that the territory you're paying to is receiving that money for a good business reason. It's your head office territory. It's where you really have your treasury operations and functions. It's going to be that kind of test. So that kind of ties into the transfer pricing thing. If you've got your profits located somewhere and your treasury located somewhere for good commercial reasons, then the withholding tax will follow. If you haven't, then the withholding tax is going to continue to be a marginal cost. On corporate structure, there's no substitute for thinking through and working through, probably with tax colleagues, where are the tension points in your corporate structure where BEPS is going to represent a cost in future. And it's then making sure that your corporate structure is BEPS compliant in that it matches what you're trying to do commercially. It matches what the OECD sees as acceptable business practice for the tax outcome you want. And in many cases, that means changes.
BEPS is clearly a revolution which is slowly going around the world. What is the single most important thing to do now?
I think it's understanding where are the bits of your structure and your treasury and your funding profile which are most at risk, taking into account the way that the BEPS legislation has developed. In some cases, for example, in the UK, we already have most of the BEPS rules turned into UK detailed tax legislation. So you can look at that legislation and understand now what are the things that will need to be different. In other territories where the BEPS proposals haven't yet turned into local law, it's about looking at the principles that the OECD have put out there and saying, assuming those principles come in, what are the things in my structure, what are the things in the way I operate, which are going to give me tax costs that I need to understand and manage?
So if we're going forward, two questions really here. One is, when will Brexit have any impact, do you think? What is the most important thing going forward in terms of outlook, things to look for? So first, Brexit.
So first, Brexit. It's still early to say how Brexit is actually going to change the UK's relationship with the EU, and that's what will drive to what extent Brexit changes UK's tax position. And it's not clear whether that will make things easier to do business in the UK or harder from a tax point of view. There are many possibilities. You'll have seen that George Osborne put out there that he was considering cutting the corporate rate to 15%. If our relationship to the EU changes, we may find more helpful changes of that type in order to encourage business. It remains to be seen. So our Brexit, from a tax point of view, is very much a watch this space and be aware that things will change. On the more general picture, what does this mean in the medium term? I think we're going to see a period where the OECD rules are being brought into force by different territories around the world, and corporates are responding to that. And I think that where we will be in a couple of years' time is that corporates will have moved to the sort of acceptable and sustainable business models that the OECD and governments want to see. And that, if you like, will become the new normal. In some cases, there will inevitably be a bit of higher tax cost. That's kind of how it is, given that the starting point for BEPS was the idea that corporates weren't paying enough tax. But managing that tax cost and building it into a structure which is one that corporates are happy to live with, from not just as kind of tax and legal, but also a business model and reputational point of view, is going to be the way forward in a couple of years' time. And clearly Treasury is an important part of that, because the Treasurer is responsible for the funding and the cash management of the business. That is an important part of the business, which has been a tool for corporates to manage their tax rates, and therefore a target of the OECD. And therefore I see that the Treasurer's role in shaping that new sustainable business model is really important.
Thank you very much. That was most interesting.